market's in a very happy mood, and what's really going on here is I think the Federal Reserve indicating that they're going to cut interest rates has pushed long-term rates down to such a low level that there is no real value in the bond market, and that is just pouring money back towards U.S. equities, and that's really what's going on. The other thing I think that's going on is the U.S. is benefiting in relative terms relative to the rest of the world, because this trade tension is really hurting global manufacturing, but it's hurting global manufacturing more than U.S. manufacturing. So the U.S. seems like the best house in a deteriorating neighborhood. I think that's what's helping U.S. stocks.
Lori, I guess the base of low Treasury yields, and they haven't moved up much at all in this news today, as well as just the relative attractiveness of stocks and the U.S. economy holding in. Again, is that enough to keep these markets moving ahead? It sounds an awful lot like the setup in 2016 after Brexit, let's say, when nothing was resolved, but the market found a way.
Yeah, there's still an incredible amount of resiliency in the consumers. Don't forget that we had retail sales that on a 3-month average basis were as high as they've been since 2003. So you still have very low unemployment, you still have very low inflation, you still have strong consumer sentiment. So it's really kind of this tension between global manufacturing and businesses and their sort of concerns about this and reluctance to invest versus consumers, which seem still very healthy and able to power the economy forward.
I don't know, David, you're seeing warning signs out there, aren't you? I mean, in terms of economic signals, I should point out, by the way, construction spending just coming in down 0.8 when it was expected to be up.
Well, absolutely. And it's correct that consumers are doing pretty well here. We're looking for about 3.5% growth in consumer spending in the second quarter, but that follows some pretty weak quarters. But I think the bigger issue is exports are really pretty weak, and investment spending, which is what we were trying to, increase with the tax cut last year, that is looking weak across the board. And construction spending is probably that's part of that story here. So I think it's an economy of two halves right now. But when you put them together, particularly because we've got an inventory overhang, I'm looking at economic growth of not much more than 1% on average in Q2 and Q3. I mean, I think we're not going to go into recession at this point, but it does look quite slow in the United States despite a healthy consumer.
So does that mean then we get 50 basis points in this month, by the way, as many expect, July?
No, I think the Fed has got to draw a line somewhere. I think what they'll say is, look, weak inflation is a good enough reason to cut rates twice. So I think we get 25 basis points in July. We get 25 basis points probably at the end of October. But they're going to have to hold their ground, because if we're not actually facing a recession, then what are they going to do when we do face a recession? If you head straight down to zero again, you've got nothing left. I think the Fed wants to avoid that.
Lori, that raises a good question. If you were to see the Fed cut interest rates again, especially in the face of weakening economic data here in the U.S., given the fact that they've been so low for so long, would it actually do enough to keep the U.S. out of a recession?
Look, I don't think there's really an issue here that we need to have lower rates to increase credit demand. We're at very, very low rates historically as we sit. I think it's more of a confidence building. And what we have right now is the Fed has taken away that concern that somehow they choke off the recovery. So that's out of play now. Now the next move is going to be, are they actually seeing something in the data that gives them cause for concern? So I do think they have a very delicate balancing act here. If they move too aggressively, too quickly, they potentially spook markets who may think that they're seeing much more deterioration in the future than they're actually seeing.